Welcome, Young Investor Society members. Today we're going to go over possibly my favorite lesson that we teach at Young Investor Society, and it is the 7 golden rules. Now think about our class last week, and we talked about Warren Buffett and the super investors and what they did to outperform the market. What would you say were the rules that they followed to outperform the market? Take a minute, think about it. What are the rules, if you were to put rules together, of successful investors? Rules are important. In any sport or in any activity in your life, following a set of rules that makes you successful will lead to your success. If you're playing soccer and want to become a great soccer player, you'll need to follow the rules of the game and also the rules of success and the fundamentals of the sport. The same is true in successful investing. Learning the rules and becoming masters of these rules will instill in you the success that you're looking for. Young Investor Society, we compiled all of the successful investors and weaned out their key traits and distilled it into what we call the 7 golden rules of investing. So today's objective is to become masters of these 7 golden rules. Are you ready? Okay, let's begin. So when we think about great investors, we can think about the 7 golden rules. The first rule is to think long term. The reality is most investors in the market, especially institutional investors like me, professional investors, are constrained by time horizons. So I have clients that are asking me for good quarterly numbers or good yearly numbers. Did you beat the market? But the reality is, if you're trying to invest successfully over a 3-month period, it's almost impossible to predict whether you can do better or worse than the market. The market is irrational, it's volatile, and it's very difficult. So one of the key advantages that you'll see from successful investors is they take a long-term time horizon to their investing. We call this time horizon arbitrage. And you're able to arbitrage the majority of the market thinking short term while you're able to have an upper hand thinking long term. And Warren Buffett said, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. That is long-term investing. The second rule of investing is good companies make good investments, and ditto for bad companies. So just like we talked about what a stock is ownership in a business. Any investment is only as good as the company that you're investing in. So if you're buying a piece of a company and that company is good and continues to grow and sell more products and generate good returns, the chances are you're going to do very, very well in that investment. And it's ditto for bad companies. It's very difficult to make money in the stock market if the company's profits decline and the company's going through turmoil. So when you're focusing on investing, focus on owning good companies in your portfolio and being owners of these companies. So what are good companies? We'll talk about this in future units, but in essence, a good company has a unique advantage that makes it difficult for others to copy. It generates high returns on capital, and it doesn't need to borrow a lot, and the business is self-financing. And in this way, it's able to grow, generate high returns on capital, and maintain to be an exceptional business. The third rule of investing is buy with a margin of safety. So what is a margin of safety? This was taught by Warren Buffett's teacher, Benjamin Graham. And he taught that when you buy, you should buy at a price that's below the intrinsic value. Just like when you're doing any investment, you want to make sure that you're giving yourself a buffer, because as smart as we think we are as investors, we always get forecasts wrong. And so you want to give yourself a big buffer that even if you get your estimates wrong, that you're still safe. Monish Pabrai, a famous investor, said, "Heads, I win. Tails, I don't lose much." And this is the way that you can ensure that even if you make a wrong call, that you still don't lose too much money. the fourth rule of investing is to do your own homework. So a guaranteed and own stocks of companies what you know. So there is no substitute for doing your own work. So a guaranteed way to lose money in the stock market is to just buy whatever they say to buy on CNBC, or buy whatever your uncle tells you to buy as a great stock tip, and then watch the value go down, which happened to many companies in the stock market. Why is that? Because when a stock goes down, what you want to be able to do is to buy more of that company if it's the right call. But if you don't know really what the business is, and you don't have what we call conviction in that investment, you're not going to have the courage, and it would be a bad decision to buy the stock when it's down. And so that's why successful investors know what they own, and they know the company. They buy stocks in companies and products that they believe in, brands that they love, businesses that they trust, and they've done their own homework. Peter Lynch, the famous investor from Fidelity, said you have to know what you own and why you own it. And so know what you own is rule number 4. Rule number 5, don't follow the herd. YIS investors are great because they're able to not just follow the herd, because sometimes the herd just runs right off a cliff. The herd tends to get swept up into momentum. So when things are good, the herd gets really excited. And when things are bad, the herd gets really pessimistic. And the key of an investor is to be able to do your own work, have your own opinion, and have the courage to not follow the herd. Stay calm and rational through the ups and downs of the market. And Warren Buffett famously said, be fearful when others are greedy, and be greedy when others are fearful. Rule number 6, don't put all your eggs in one basket, but also don't have too many baskets either. So why don't we want to put all our eggs in one basket? Because we're never 100% right. The reality is, in my investing career, if I'm right 6 times out of 10, then I am doing fantastic. And if on the 4 times when I'm wrong, if I protect myself, then I don't lose too much. And so diversification is important to any investment portfolio, because we're never right 100% of the time. But also, don't have too many baskets either. What we know is that research suggests that over 90% of the benefits of diversification can be accomplished if you own 20 stocks in your investment portfolio. So the reality is, your first best idea or your 5th best idea is going to be better than your 100th best idea. And so diversification is important, but up to a certain point, you don't want to have too many baskets. You want to focus on your high conviction best ideas. Make your best ideas count. And Warren Buffett said, try to avoid buying a little of this and being lukewarm about businesses and its price. When we are convinced as to its attractiveness, we believe in buying worthwhile amounts. So the 7th rule of investing is never stop learning. And the reality is, this could be the most important rule, because investors, we never know everything, and we're always learning. And businesses constantly change. So learn, and then keep learning. And we would say at Young Investors Society, this is potentially the most important rule. So these are the 7 golden rules of investing. We want to throw an additional 8th bonus rule of investing, and this rule is, when you become successful, when you build wealth, find ways to give back to the world. Find ways to have an impact in the world. And the reality is, if you look at Warren Buffett, he's one of the most generous, philanthropic people in the world. And so find ways to give back. You at Young Investors Society, if you follow these rules, we have no doubt that you will become successful, that you will become wealthy, and so we'll challenge you to give back and find ways to make an impact on the world. So can you remember all of the 7 golden rules of investing? We know what they are. Think long term. Good companies make good investments. Buy with a margin of safety. Do your own homework and own what you know. Don't follow the herd. Stay calm and rational. Number 6, don't put all your eggs in one basket, but don't have too many baskets either. Number 7, never stop learning. And number 8, the bonus rule, once you become successful, find ways to give back in the world. We hope you enjoyed these 7 golden rules of investing. It's one thing to know them, it's a whole nother thing to follow these rules stringently and become masters of these rules. But what we have seen from history is if you become expert into becoming a super investor like the ones we talked about and following the 7 golden rules of investing, you too can be incredibly successful investing in the stock market. And so now let's do handout 1.4 and go through different scenarios and try to identify what golden rule this person is following and which would be the best investment in this scenario. Thanks so much. Okay, how did you do on the activity? Did you follow and were you able to identify the 7 golden rules? Let's find out. So question number 1, the answer was company A, and the rule is buy with a margin of safety. So in B and C, we see that they were not bought with a margin of safety, but company A, you were able to buy at a 50% discount, so you were giving yourself that margin of safety. The answer to number 2 is B, and the rule that they are following is thinking long term. So in example A and C, they were uncertain on the time horizon. It was iffy, the investment in the future, but company B was able to take a long-term approach to a good investment. Number 3, the answer is B, and the rule is rule number 5. Don't follow the herd, stay calm and rational. Question number 4, company A is the answer, and the rule that they're following is rule number 2. Good companies make good investments. Fill your portfolio with companies that you believe in, and that will make for good investments. Question number 5, the answer is company C, and the rule is do your own homework, own what you know. And it was company C that they had done the work and that they had the research on the company. And the last one, question number 6, the answer is B. And don't put all your eggs in one basket, and the power of diversification. So I hope that was a fun activity, and I hope you learned about the value of the 7 golden rules of investing. Okay, so I hope you enjoyed that lesson, the 7 golden rules of investing. We want to take a couple questions and answer them. These are the frequently asked questions when we teach this lesson. So one question that we received was, do the super investors, do the great investors, do they follow all of the 7 rules, or do they follow just a couple of them? And is it still good to invest if you follow a couple rules, but not all of them? Great question. And so what we find is the majority of successful investors follow all of these rules. But there are investors that, for example, invest with a short-term time horizon, but they give themselves a wide margin of safety. And there's hedge funds that are successful investing that way. What I would say is the more rules that you're able to follow, the more successful that you will be as an investor, and the more confidence you'll have that you'll able to be successful and add value over the long run. There are also some rules that are crucial to follow, and these are that good companies make good investments. And so the reality is it's hard to be a successful investor if your portfolio is full of garbage companies or companies that are going to destroy value over the long run. And so there are some rules that I would not break for anything. Second question that we receive often is, James, these 7 golden rules are great for Warren Buffett or investors with a lot of money, but I'm just starting to invest with a couple $100, let's say. Should I be following all these rules, or should my rules be different? It's a great question, because when you're young and with a small amount of money, maybe you do want to take more risk. And so you do have a long-term time horizon, and maybe your risk threshold is higher than someone that, for example, needs that money to live on. And so in that case, I would still say follow all the 7 golden rules. But what we talked about earlier is that you can have different risk tolerances, and you can increase your risk, which will increase your potential return. And so you can follow these rules in safe investments, and you can follow these rules in risky investments. And some will say, yeah, but James, I want this money, I want to shoot for the moon, and I only want to put a small amount of money in. And the reality is, the more return that you're expecting for that investment, the riskier it is. And so if you're trying to take $100 and turn it into $1,000 over 2 years, you may be successful, but the chances are very good that $100 is going to go down substantially. And so the more return that you're shooting for, the more risk that you're taking on. So it's good to be aware of and take into account. A third question that we receive is on the margin of safety. So this is a new term for young investors. And the question would be, what is an appropriate margin of safety? And what is that buffer that you want to buy at a discount to follow that rule? In general, you want a margin of safety that is a greater return potential than the risk that you're taking on. One of the common symbols is Benjamin Graham talked about buying 50-cent dollars. So buying dollars for 50 cents. And so what is your margin of safety in that example? It's 50%. And so you want to buy at a 50% discount to the intrinsic value that you think that company is worth. And so if you're able to buy with a margin of safety of 50%, let's say, then you're in very safe territory. And so the number of exact margin of safety that you want to shoot for is different. But what I would say is the smaller that margin of safety, the more risk that you're taking on, and you want to give yourself a big buffer to be wrong, because in investing we're all wrong. So I hope these questions help understand the 7 golden rules, and I want to emphasize, follow these rules and you will be successful in your life. And then the last rule, the 8th golden rule, find ways to give back when you become wildly successful through these 7 golden rules. Thanks for watching, and thanks for investing.